Assalamualaikum sir, my name is Nur Farahliana binti Muhammad Firdaus and my matrix number is UDE 210096. So today I would like to describe about part 1 for the property plan. So what is the situation that I had created based on the property plan and equipment? Let's see. So the situation for the property plan and equipment is property, plant and equipment was acquired on 1 January 2019 at the cost RM623,445 and the depreciation cost was RM745,434. In the year 2020, AH Berhad will not buy any additional property, plant and equipment but will have depreciation for the existing property, plant and equipment. Similarly, in 2021, AH Berhad did not buy any property, plant and equipment and had no depreciation in that year. The property, plant and equipment was originally estimated to have a salvage value of $5,000 and an estimated life of 10 years. Depreciation has been recorded through 31st December 2021. Using the straight line method, AH Berhad intends to calculate the rate of property, plant and equipment and depreciation expenses for the year 1 January 2022. The estimated salvage value was revised to $8,000 and the useful life was revised to a total of 9 years. So for the A, the book value at the time of revision, which is on 1 January 2022, the way we calculate the depreciation as follows. And followed by the B, which is the revised annual depreciation. The way that I calculated the annual depreciation as follows, as I stated in the slide. And we will be curious on how depreciation affects the financial statements. Depreciation reduces the value of property, plant and equipment on the balance sheets as the value of assets is lower over time due to wear and tear and the reduction of their useful life. The depreciation expense is used to reduce the value of the net balance and it flows to the income statement as an expenses. And now, how can PPE can be recognized? PPE should be recognized as an asset if it is probable that future economic benefit associated with the asset will flow to the entity and the cost of the item can be measured reliably. Future economic benefits occur when the risks and the rewards of the asset's ownership have passed to the entity. Can PPE be de-recognized? Yes. The answer is yes. PPE should be de-recognized either on disposal or when no future economic benefits are expected from its or disposal. A gain or loss on disposal is recognized as the difference between the disposal proceeds and the carrying amount of the asset at the date of disposal. What is the initial measurement of PPE? Property, plant and equipment is initially measured at the cost, subsequently measured either using a cost or revaluation model, and depreciated so that its depreciable amount is allocated on a systematic basis over its useful life. For the subsequent measurement will mean how PPE costs initially recognized should be affected for change in value or condition. Subsequent to initial recognition, PPE is measured per either cost model or revaluation model. For the depreciation policy of PPE, PPE declines in value over time. Depreciation is the process of allocating the cost of the asset over its useful life to account for a reasonable amount of exhaustion, wear and tear of the property used in business. It represents how much the value of the asset has been used up. Thank you. That's all from me for the property plan and equipment part. Next, I would like to pass to Shazwani to continue about the inventories.
Thank you, Farah. And hi, sir. My name is Shazwani Sofia, and my matrix number is UDE 210124. Today, I will be presenting about inventories.
Recognition of inventories. Inventory is a major part of business activities that are expected to generate revenue and profit after selling an inventory.
As we know, inventory is a current asset and is presented in the company's statement of financial position. However, the company is responsible to maintain the size of inventory for efficient production and sale of profitability. According to MFRS 102, inventories are held for sale in the ordinary course of business. An inventory can be recognized as an asset if it meets the definition of asset, which is defined as a resource controlled by the entity as a result of past event and future economic benefits are expected to flow to the entity. Besides that, MFRS also indicates that inventory should be measured at the lower cost and net realizable value. Now is the classification of inventories. Inventories are classified differently according to its nature. Inventories have three categories, which is raw materials, work in process, and finished goods. Raw materials includes materials that intend to be consumed in the production of finished goods. Work in process include items that were in the middle of the production process that not yet ready for sale to the customers. When it turns to finished good, it includes goods that are ready for sale to the customers. Furthermore, retailers or distributors usually deal in merchandise products, while manufacturers deal with inventories in different stages. Moving on with initial measurement. According to MFRS 102, inventory should be measured at lower cost and net realizable value except for inventories that are certain specialized industries, such as agriculture and forest products, mineral and commodity, to comprise cost of purchase, which is purchase price, import duties, and other taxes, which means other than those subsequently recoverable by the entity from the taxing authorities. Next, cost of conversion is cost that directly related to the units of production, such as direct labor. It also includes a systematic allocation of fixed and variable production overhead that incurred in converting material into finished goods. Fixed production is indirect overhead costs of production that remain relatively constant regardless of the volume of production, such as depreciation and maintenance of factory. On the other hand, variable production is indirect overhead cost of production that change directly or nearly with the volume of production. Not just that, normal production overheads refer to a range of production level expected to be achieved during various cycles or seasons under ordinary circumstances. Other costs is included in the cost of inventories only to the extent that they are incurred in bringing the inventories to their present location and condition, such as non-production overhead or the cost of designing product for specific customer in the cost of inventories. Now, for cost formula. Cost formula is the cost of inventory of items that are not ordinarily exchangeable and cost of service produced for specific project. The issue that arises from the use of raw material and products is how to assign the cost to different types of product produced in order to determine the cost of sales and closing inventories. The value of opening and closing inventory are determined by using the cost formula. Therefore, Air Asia Berhad, a multinational company, must consistent in using the types of formula for each classes of inventory. According to MFRS 102, the inventories are permits the use of any three formula to determine the closing inventory and cost of goods sold, such as specific identification, first in, first out, FIFO, and weighted average. Next, in order to measure inventory at the time of recognition is when it is measured at the cost. On the other hand, if the cost is higher than the net realizable value of the inventory, it should be written down. Not just that, the market or cost should not be lower than the net realizable value less normal profit margin. As we analyze the financial statement of AirAsia as Berhad, we can see that the inventories on 1 January 2019 is RM 13,102. In the year 2020, AirAsia X Berhad did not have any inventories incurred or writing down. In the financial statement, same goes to the year 2021. So, AirAsia X Berhad can gain more inventories by using specific identification method that requires the cost of each item to be identified separately, so it will be easy for their accountant to analyze the inventories on the particular month. Therefore, assuming that AirAsia X Berhad upgrade their number of seats to 250 of hot seats, 350 of premium flatbeds, and adding one of their merchandise to 1,000 of aircraft model A32. Now, using the specific identification, 250 of hot seats is 120 price per unit, which total 30,000. Now, for the 350 premium flatbeds is 750 price per unit, in total 262,500. Lastly, for the 1,000 aircraft model is 109 price per unit, and in total is 109,000 ringgit. So we get the total cost of inventory is 401,500 ringgit. Lastly, we calculate the cost of goods sold, and at the end we get 152,300 ringgit. If AirAsia X Berhad used this method, it helps in efficiency of tracking the inventories and merchandise from the time it enters the company. If we want to compare with the closing inventory of AirAsia Berhad, it is much lower. If we use specific identification, in this case, it will increase the company profit. So that is all from my part inventory. I pass it to Gavin to continue. Thank you.
Thank you, Shaz, for providing useful explanation about the inventory part. Before I continue with trade receivables, also known as account receivables part, I would like to say a very good day to Sir Yakzan. My name is Gavin Chong and my matrix number is UDE 210168. In today's video presentation, I would like to present about the policy of measuring the recognition and derecognition of trade receivables. First of all, before we move to our topic today, there is one question that I would like to ask. The question would be, what is trade receivables? In my opinion, trade receivables can be defined as an entity claimed to the future collection of money or services with fixed or determinable payments that are not quoted in an active market. Let me provide an example for you. Trade receivables is a kind of payment that we haven't collected back when someone purchased things or services from us by credit. The payments that someone owes us can be paid in the kind of either pay by cash, by bank-in, or by check. An entity should recognize a financial asset or financial liability in its statement of financial position. The entity should record it when the entity becomes party to the contractual provisions of the instruments. An entity has the right to receive payment from its customer after complete the service to the customer. If the customer unable to pay us back the money, then we should deduct the money from trade receivables category and classify the amount into bad debt account. There are several ways that would able to help customer to pay us back the money. First of all, we can provide some discount for those who settle the payment in a given period. As example, Give 2% of cash back if they able to settle the payment in 30 days starting from the purchase date. Secondly, I would like to continue with the classification of trade receivables. According to the Malaysia Financial Reporting Standard, also known as the MFRS, trade receivables can be classified as current asset in the financial asset of the financial statements. It will only be classified when trade receivables expect to realize the asset or intends to sell or consume it in its normal operating cycles. Secondly, it holds the asset primarily for the purpose of trading and realized within 12 months after the reporting period. Receivables can be classified into 3 types, which are account receivables, not receivable, and other receivables. Account receivable, also known as the trade receivable, usually appear in financial statement because of sales. It appears as a result of customer buying goods or services on credit. Secondly, notes receivable. Notes receivable can be defined as have a physical form of a formal letter which stated the customer name with the amount that they need to pay. Normally, this type of loan has a bill of between several months. If the debt being settled within the time stated, it will not charge an extra interest. But if debtor requests for extension, then interest will be charged. Lastly, other receivable is a broader type, as other receivables include interest and salary receivables and tax refund. Due to the nature of the other receivables, it can be recorded separately in the balance sheet. Thirdly, the derecognition of trade receivable. The derecognition of trade receivable refers to the removal of asset and liability from one particular entity's financial statements. The entity shall derecognize a financial asset when the contractual rights to the cash flows from the financial asset expired, or when the financial asset met the condition which are the entity has no duty to pay all of the amounts to the recipients, unless it collects equivalent amount from the first asset, apart from as security to the eventual recipients for the necessity they need to pay, and thus the entity has an obligation to remit any cash flows it collects on behalf of the eventual recipients without material delay. Besides, the transfer qualifies for derecognition in accordance with when an entity transfers a financial asset, it shall be evaluated to which it retains the risks and rewards of ownership of the financial asset. In the case, if the entity transfers both the risks and rewards of ownership, the entity shall derecognize the financial asset. Next, the entity shall recognize it separately as asset or liabilities, or if the entity retains substantially all the risks and rewards of ownership of the financial asset, the entity should continue to recognize the particular financial asset, and if the entity either transfers or retains substantially all of the risks and rewards, the entity shall determine whether it retains control of the financial asset. Secondly, transfer that qualify for derecognition means that if an entity transfers a financial asset during a transfer for derecognition, it is entirely and retain the profit to service the financial asset for a fee. Next, transfer that don't qualify for derecognition refer to if a transfer does not result in derecognition due to the entity already have retained substantially all the risks and rewards of the transferred asset. The entity shall continue to recognize a financial asset. In some periods, the entity shall recognize any income on the transferred asset and any expenses incurred on the financial liability. All of the gain or loss in derecognition are recognized in the statement of profit or loss and other comprehensive income. Besides, derecognition of the financial asset on the differences between the carrying amount and therefore the consideration received should be recorded also in the statement of profit or loss. Lastly, the initial measurement. At initial measurement, financial assets are classified as at amortized cost, fair value through other comprehensive income, or statement of profit or loss. If the fair value of the financial asset or financial liability at initial recognition differs from the price of transaction, the entity should recognize the asset initially at its fair value on the trade date. Financial assets are derecognized when the rights to receive cash flows from the financial assets have expired or have been transferred, and the entity has also transferred all of the risks and rewards of ownership. For trade receivables, the transaction price is deemed to be equal with its fair value. Besides, these assets are carried at amortized cost using the effective interest method less all of its allowance for expected credit losses. Next, we move to the part B, which is the producing a situation. As a result from the financial statement of AirAsia X Berhad, we can figure out that the company trade receivables or account receivable for the year 2021 is 119,604, while in the year 2020, AirAsia X Berhad doesn't have any trade receivable or account receivables that have been wrote down in the financial statement. To receive back more trade receivables, AirAsia X Berhad need to set down more strict rules, such as give that company, the account receivables, a particular time to settle all of the debt that owed to AirAsia X Berhad. Next, we will continue with the scenario about the bad debt of AirAsia X Berhad. On May 2021, the Philippine Airlines bought 200 second-hand Airbus A330 seats from AirAsia X Berhad with the total price of RM20,000. The Philippine Airlines bought them by credit and promised the AirAsia X Berhad to settle the unsettled amount in 6 months. But, unfortunately, the Philippine Airlines announced that they already filed the bankruptcy policy on September 2021. So, AirAsia X Berhad has been meeting with the board of directors. They confirmed to classify the Philippine Airlines debt as much as RM20,000 as bad debt. To get the net trade receivable, we need to deduct the bad debt amount from the gross trade receivable. As a result, the gross trade receivable of AirAsia X Berhad after deducting the bad debt amount of the Philippine Airlines would be RM99,600. Bad debt that had been classified will reduce the amount of trade receivables in the financial statement, which is the statement of financial position. Bad debts will occur when the party which have the right to collect the debt unable to claim back the money from its account receivables due to several reasons. As example, the account receivables already bankrupt or the owner passed away. Bad debt will also be revenue or expenses, and it will be recorded in the statement of profit or loss. Bad debt will be revenue when the existing bad debt is less than the new value. And bad debt will be expenses when the... That's all from me for the account receivable part. Next, I will pass it to Fatin to continue with part B.
Hello, greetings. My name is Nofatin Wahida binti Siswadi. I am from Group 2 and my matrix number is UDE 210097. So let's start with our video. So let's start with the first question. Does all asset have the same definition? Before I tell you the answer, let me tell you what is asset. What is an asset? An asset is a resource with economic value that an individual, corporation, or country owns or controls with the expectation that it will provide a future benefit. Assets are reported on a company's balance sheet and are bought or created to increase firm's value or benefit the firm's operation. An asset can be thought of as something that in the future can generate cash flow, reduce expenses, or even improve sales, regardless of whether it's manufacturing equipment or a patent. There are few types of asset: current asset, financial asset, fixed asset, and intangible asset. So let's start with current asset. Current asset is a short-term economic resource that are expected to be converted into cash within 1 year. Current asset include cash and cash equivalent, account receivable, inventory, various prepaid expenses, stock and other marketable securities and supplies. While cash is easy to value, accountants periodically reassess the recoverability of inventory and account receivable. If there is evidence that account receivable might be uncollectible, it will become impaired, or if inventory become obsolete, companies may write off this asset. Next, financial asset. Financial asset represent investment in the asset and securities of other institutions. Financial asset include stock, sovereign and corporate bonds, preferred equity, and other hybrid securities. Financial assets are valued depending on how the investment is categorized and the motive behind it. Now, the definition of fixed asset. Fixed assets are long-term resources such as plants, equipments, and buildings. An adjustment for the aging of fixed asset is made based on periodic charge called depreciation, which may or may not reflect the loss of earning powers for a fixed asset. Generally accepted accounting principles, the GAAP, allow depreciation under two broad methods. The straight-line method assumes that a fixed asset lost its value in proportion to its useful life, while accelerated method assumes that the asset loses its value faster in its first year of use. Lastly, for the intangible asset. Intangible assets are economic resources that have no physical presence. They include patent, trademark, copyright, and goodwill. Accounting for intangible assets differs depending on the type of asset, and they can be either amortized or tested for impairment each year. So, the answer to the question earlier, does all assets have the same definition? The answer is no, it does not have the same definition.
Thank you, Fateh. Hi guys, my name is Praveen, and my matrix number is UDE 210108. So let's ask ourselves, what is the differentiate between plant, property, and also equipment? Plant assets are a group of assets used in an industrial process such as a foundry, factory, or workshop. Besides that, these assets are a subset of the fixed asset classification, which includes such other asset types as vehicles, office equipment, and intangible assets. Furthermore, plant assets fulfill the usual criteria for a fixed asset, which means that their initial cost exceeds the capitalization limit of the entity, and they are expected to be used for at least 1 year. Then, they must also be reviewed for impairment at regular intervals. This classification is rarely used, having been superseded by such other asset classification as buildings and equipment. Furthermore, plant assets are depreciated over their useful life. The only expectation is land, which cannot be depreciated. Plant assets are recorded within the property. So just now we talked about the plant, now we go for the property. Property is a term describing anything that a person or a business has legal title over, affording owners certain enforceable rights over said items. Examples of property, which may be tangible or intangible, include automotive vehicles, industrial equipment, furniture, and real estate, the last of which is often referred to as real property. Most property hold current or potential monetary value and are therefore considered to be assets. But properties can be simultaneous liabilities in some situations. Case in point, if a customer sustains an injury on a company's property, The business owner may be legally responsible for paying the injured party's medical bills. Intangible property describes assets such as stock and bond certificates that represent current or potential value but don't carry intrinsic. While these items are merely pieces of paper, they might represent significant amounts of money. Other types of intangible property, such as a brand's reputation, are more nebulous and cannot be signified by a paper document. Intangible properties like design concept, song lyrics, books, and screenplay are categorized as intellectual properties. Besides that, even though these are not physical in nature, they may carry significant value. Examples: intellectual properties include Nike's swoosh logo and the chemical formula for Coca-Cola. Last but not least, equipment. So, equipment is a non-current or long-term asset account which reports the cost of the equipment. Besides that, equipment will be depreciated over its useful life by debiting the income statement account depreciation expense and crediting the balance sheet account accumulated depreciation, which is a contract asset account. So let's say a large corporation owns a large facility with several buildings and a large parking lot that the employee use to park their vehicles. The company is so large that they have a facilities department made up of several employees who maintain the overall facility, including the parking lot. In preparation for winter, the manager of the facilities department is required to purchase 3 snow blowers to ensure his employees have the necessary tools to clear snow from the company parking lots. Therefore, the facilities manager purchased 3 snow blowers for $3,000 and each will be $1,000 and places them into service. Thus, he estimates the snow blowers will be used for 5 years and all supporting documentation for the snow blowers is provided to the accounting department. So that's all about the equipment. So that's all from me regarding the plant property and also equipment. Hope you guys enjoy it and get some new knowledge. Next, I will pass it to Sumi. Thank you.
Hello sir and my fellow friends. Let me introduce myself first. My name is Dae-Soo Lee and my matrix number is UDE 210127. The part that I'm going to present is part B, question C. Does intangible asset consist in non-current asset? So now I'm going to present about it. Non-current asset can subdivide into tangible and intangible asset. We can call non-current asset as a fixed asset because it is an asset that cannot convert into cash easily and will realize after 1 year or more. First of all, intangible asset is an identifiable non-monetary asset that do not exist in physical form, but it brings beneficial economic value to the company. So, the useful life of intangible asset can be either indefinite or finite. For instance, brand recognition is one of the intangible assets that has indefinite useful life, which will exist as long as the company stays operate, while patents and copyright can be considered as intangible asset that has finite useful life because It will only exist during the period of agreement and contract. Intangible assets are recorded in non-current asset category of the statement of financial position. Examples of intangible assets are goodwill, trademark, and also included the examples stated in the previous slide. These intangible assets mostly last longer for more than a year. Therefore, the nature of intangible asset is matched with non-current asset. So, the intangible asset can consist in non-current asset. For the further elaboration, intangible assets are consist in non-current asset but not as current asset. This is due to the accounting purpose for the company economic benefit normally goes beyond 1 year, and it cannot be liquidated into cash within 12 months. Hence, intangible assets are long-term assets. Although it cannot be touched or physically destroyed, but it still consists under non-current asset. To answer the question, it is a yes. Intangible asset is consist in non-current asset. For the further information based on MFRS 138, the item can be recognized as intangible asset when it meets the definition of intangible asset, which are identifiability, which means that the intangible asset can be separate from the entity or divided from entity and sold, transferred, licensed, rented, or exchanged. It arises from contractual or other legal rights. For the second one will be the control by the entity. It means that the entity has control over the intangible asset. Entity has the power to obtain the economic benefits while using intangible asset and restricts other entity to access the benefit. For the third one will be future economic benefits, and this will explain in the next slide. For the previous slide is A, now is until B, the intangible asset meet the recognition criteria. The first one will be, it is probable that expected future economic benefits that are attributable to the assets will flow to the entity. And the second one will be, the cost of the asset can be measured reliably. Based on MFRS 138, initial measurement of intangible asset is measured on cost. The cost of intangible asset comprise the first one, the purchase price including import duties, non-refundable purchase tax, less trade discount and rebates. For the second one will be any directly attributable cost of preparing the asset for intended use. However, intangible assets are little different with other non-current assets such as property, plant, and equipment. Although both of these assets are also consisting as non-current assets, but intangible assets do not depreciate like property, plant, and equipment because intangible assets are using amortized method. Both of depreciation and amortization are recognized as expense in statement of profit or loss. But still, there is an exception. Intangible asset will not be amortized if the useful life is perpetual. For example, goodwill generated internally. This is because we are not be able to determine the useful life of goodwill as there is no expected lifespan for the goodwill. Therefore, this has shown that indefinite intangible asset is not amortized. Entity need to disclose carrying amount of indefinite intangible asset, and the reason supporting the assessment of an indefinite useful life. The second will be description on carrying amount and the remaining amortization period of any individual intangible asset that material in financial statement. And for the third one will be existence and carrying amount of intangible asset whose title is restricted, and the carrying amount of intangible asset pledged as security for liabilities. And the last one will be the amount of contractual commitment for the acquisition of intangible asset. The recording in the statement of financial position is depend on the situation. For example, when Company A purchased the patents of advanced technology which cost Rm 1 million from Company B for 10 years lifespan. So, based on MFRS 138, intangible asset can be recorded on the balance sheet under non-current asset only when the company buy or acquire it with identifiable value and useful life of the intangible asset. Therefore, purchase value of the patents can be recognized. This is due to patent is arise from purchase of business units and the cost can be reliably measured. The future economic benefit which the company also be able to generate cash when the technology is used to produce a product and earn profit from sales. Additionally, amortization will calculate by using amortization straight line method. So there will be Rm 100,000 of amortization expense be recorded in the income statement. On the other hand, intangible asset will not be recorded when it is created by the company. For instance, logo that created by company itself, which the value will not be recorded in the balance sheet. This is because the logo is created internally and the company are not be able to determine the fair market value of the logo. So, therefore, it cannot be measured reliably. So, what is the importance of intangible asset? From the point of view of business entities, it enables a company to have a strong competition advantage. Why do I say like this? This is because brand recognition and goodwill are significant for the organization to build trust and also increase customer loyalty. It will help in promoting sales and increasing the sales revenue when a company has a good reputation. For example, customer will buy shoes from Adidas rather than the unknown brand. This is because a strong brand can affect customer decision making. From the point of view of investor, intangible asset of the company is important for them to know how the company manage the asset and determine whether the company can use the intangible asset to earn much profit. So this is very significant for the investor to make a right investment decision. So in the conclusion, the intangible assets are consist in non-current assets. That's all for my part. Thank you for listening. Let me pass it to another person, Gavin, to continue his part.
Thank you, Sweely, for providing useful information about the intangible asset. Next, I would like to continue with how does inventory be recorded in a corporation. First of all, inventory in a corporation are recorded by using three types of method. First in first out method. The second will be last in first out method, and the last one will be weighted average cost. First in first out method means that goods which purchased first considered to be issued first. Thus, the costs are based on the earlier purchases of goods. The closing inventory would be the value of the latest purchase. When recording the inventory, must follow the sequence of date, which means that the things that purchased at the earlier of the month will be at the upper side. Secondly, last in first out method. Last in first out method is not the same as first in first out method. In last in first out method theory, the things that last purchased will be considered to be used first. When there is not enough left of the last batch, then the balance needed is assumed to come from the previous batch. Lastly, weighted average cost. The issued price is based on the weighted average price of the purchases prior to the issue. This weighted average cost helps to overcome the problems arising from wide price fluctuations. Nevertheless, it involves complicated calculation too if compared to last in first out method and first in first out method. That's all from me. Next, I will pass it to Farah to continue. Thank you.
Thank you, Gavin. Hello and Assalamualaikum, sir. My name is Nur Farah Liana binti Muhammad Firdaus and my matric number is UDE 210096. Today, I would like to describe for the E part on why do we need first in, first out inventory recording system in our corporation. So, why do we need first in, first out inventory recording system in the corporation? It is because under this method, materials are issued and priced at the earliest purchase price based on the concept of first in, first out. In other words, the materials issued are priced in the order in which they are received in the stores. As such, the pricing of the issues of the first lot of issue is at the cost price at the first lot of purchase. The subsequent pricing pattern follows for the subsequent lots. Using the FIFO method, which is first in, first out, the closing stock is valued at the latest purchase price and thus it represents the current market conditions as far as possible. Does the FIFO method has the advantages? Yes, it is. The advantages of the FIFO method is it is a logical and simple method to operate. The materials are charged at cost only, so the purchase price is recovered in full without showing any profit or loss on issue. Next, this method is appropriate during rationary periods where the prices are falling, the consumption rate of the materials is low, and last but not least, the closing stock is shown at the market prices. But then, sadly, to inform that FIFO method also has their own disadvantages, which is it is not suitable method during inflationary period where the prices show a rising trend. The same type of materials issued for two jobs at two different prices will show different costs, and then clerical errors may occur when prices fluctuate frequently. So, in a nutshell, FIFO method is often method that used by the corporation other than other method. Next, I would like to pass to Shazwani for the other question. Thank you, sir.
So, I'm Shazwani and I will answer part 2F, which is does every corporation need to have a financial instrument? So, what is financial instrument? Financial instrument is about financing the business and identify whether the instrument relates to asset, liability, or even equity component. Not just that, financial instrument is known as a financial contract between two parties, which is one party represent an asset and liability to another, and it is an agreement between two or more parties involved. For example, issue of shares, bond, and subscription of financial instrument issued by other entities. So, financial instruments include primary instruments such as receivable, payable, and derivative financial instruments such as financial option and financial interest swaps. Next, financial instrument is considered as liability when instrument is account payable or long-term loan. Now, we know that a company does need a financial instrument because financial instrument can allocate risk area and the company can hedge currency for future uncertainty. So, the company's stakeholder will feel more secure that has employed more capital in its liquid asset. Two additional information, for example, when an invoice is issued on the sale of goods on credit, the entity has sold the goods is considered as financial asset, which is receivable, while the buyer has to account its financial liability, which is payable. For the second example, the entity that subscribed to the bond needs to lease the money, so it considered as financial asset, and do some investment, while the issuer of the bond, which is the borrower who has raised the finance, has to account for the bond as a financial liability. Not just that, to extend the information in financial asset have two types, which is equity and debt instrument, which can split into different categories. So, equity investment are likely to be shares that have been purchased in a company but not enough to give the investors significant influence, control, or joint control. So now, debt instruments are usually bonds or loan notes or other instruments which are likely carried interest and capital elements repayment. The treatment of debt insurance depends on the intention of the entity. Now, for the financial liabilities will be held at amortized cost. It will be similar to the asset held under amortized cost. Instead of having investment income and an asset, there will be different accounting treatment related to the initial treatment upon issues of the financial liability. So, when we talk about accounting for financial instrument, in simple terms, what we're really talking about is how we account for investors in share, investors in bonds and receivable, which is financial asset, and how we account for trade payables and long-term loans, which is financial liability, and how we account for equity share capital, which is equity instrument. So that is all from my part answering question F. And we'll be moving forward to the next person, which is Fatih. That's all from me. Thank you.
So next question, is it better to have a financial asset or a current asset? Before we get to the answer, let me explain to you first what is financial asset and what is current asset. What is financial asset? A financial asset is a liquid asset that gets its value from a contractual right or ownership claim. Cash, stock, bond, mutual fund, and bank deposit are all examples of a financial asset. Unlike land, property, commodities, or other tangible physical assets, financial assets do not necessarily have inherent physical worth or even a physical form. Rather, their value reflects factor of supply and demand in the marketplace in which they trade, as well as the degree of risk they carry. These are some of the examples of the financial asset. What is current asset? Current assets are any asset that can be converted into cash within a period of 1 year. These count products that are sold for cash as well as resources that are consumed, used, or exhausted through regular business operations that are expected to provide a cash value return within a single year. Current assets reflect the ability of a company to pay its short-term outstanding liabilities and fund day-to-day operations. So, let's get back to our question. Is it better to have financial asset or current asset? The answer is the current asset. Why, you may ask? It is because financial assets are highly liquid assets that are either in cash or can be fast converted to cash. They include investments such as stock and the bond. The major feature of financial asset is that it has some economic value that is easily realized. However, by itself, it has lesser intrinsic value. On the other hand, current assets, which also can quickly be converted to cash and which are typically held for less than a year. For example, cash and account receivable. That's all from me. Thank you for watching and have a good day.
Thank you very much, Fatin. Greetings and salutations to Sir Yaksai. My name is Tengku Menawi bin Tengku Muneh, and my matrix number is UDE 210129. Today, I'll be answering question H of part 2 of the FAR group assignment. So, what is a contingent asset? Well, by definition, a contingent asset is a potential economic benefit that is dependent on a future event or events which are largely outside a company's scope of control. This subsequently means that a contingent asset is also known as a potential asset. Well, how are they confirmed? Well, here's your answer. These potential assets are only confirmed through the occurrences or non-occurrences of one or more uncertain events. Through these unplanned or unexpected events, they will give rise to the possibility of an inflow of economic benefits to an entity, which is what a contingent asset arises from. And once this contingent asset is disclosed, it means that an inflow of economic benefits is probable. So, what contingent assets might AirAsia face? As an example of a contingent asset that AirAsia might face is the returning rise of people who want to travel. Since 2020, everyone has been hit by the COVID-19 pandemic, which has not only barred the borders of some countries, but it has also not allowed people to travel to places they wanted to go. Now, 2 years later in 2022, it seems as though this COVID-19 pandemic may finally come to an end with the introduction of the vaccines and booster doses. This possible event will once again create a surge of income for the travel companies. Now, why do you think this would happen? Well, this is because AirAsia has already cemented itself as one of the world's best low-cost airlines, which predominantly caters to those who plan to travel on a budget. And due to the recent economic drops which followed the COVID pandemic, many travelers won't have the luxury to hop aboard airlines which charge absurd amounts of money to get them from one country to another. This will result in them turning to more cost-efficient options, and at the top of the list will be AirAsia, potentially turning them into the most reputable and famous airline in the world. The answer to my question. Thank you very much for listening, sir, and please have a good day.